All right, so let's begin the show and let's start by talking about sovereign gold bonds. SGP 2015 Series 1 can be redeemed at rupees 6,132 per unit from today with annual returns up to almost 12.9%. The first tranche was priced at rupees 2,684 per gram. Now, these bonds now have delivered almost 128.5% on absolute basis when redeemed at rupees 6,132 per gram and 152% gross return when added with interest. Now, which means the appreciation that you can see has gone up to almost 3,448 in addition to interest payment of rupees 627. Now, at 2.75% interest, rupees 2,684 in SGBs yielded rupees 37 every 6 months and rupees 627 in total interest in over 8 years. Now, giving in total of rupees 6,759 or 6,759 when it reached the final redemption. So, we've seen the kind of trajectory and the kind of gain an investor is having in this first tranche, which is to be redeemed from today onwards. But then let's decode this benefit. Let's understand the maths of this interest earned. And, you know, there's a lot of a calculation and a lot of maths going on in between. But then going on ahead, will we be seeing the same kind of benefit in sovereign gold bond? You know, how much the currency depreciation has helped, interest rate hikes have impacted gold prices, and what's the way ahead? Today I have with me Shweta Rajani, Head Mutual Fund, Anand Rathi Wealth Limited. Shweta, good evening and welcome to the Money Show. So clearly, investors have gained a lot, 128.5%, you know, and almost slightly more than 12% compounded interest also. Definitely a fantastic investment. But then over the period of 8 years, if at all you've been locked in, if you've been one of those investors who had that amount of patience or those patience, you know, to just stay put in a particular investment, I want to understand the maths that has gone beyond it, because 2.75 or 2.5% above the market rate was also one of the important features or the main features of SGB.
Good evening, Kavita. You're absolutely right that, while on the face of it, it's gold investment that has delivered you a 12.5% kind of a return. But not to forget, if this was, in a gold fund, which did not have the benefit of the 2.5% of coupon coming to you, the return would have been closer to, a 10.5, 11-ish for the same tenor of 8 years if we are seeing. And if I look at just gold in dollar terms, clearly you can bring down another 4% odd to this return. So it is what has contributed. If I break it up, the pure gold return could be just 50%. The rest 50% that you've earned clearly can be attributed to the rupee depreciation as well as the additional, coupon that you've gotten. Also, just like I said, if this was a gold fund, you would have still ended up with somewhere around a 10.5, 11% return with a liquidity that you would have got at any point you wanted. So the liquidity premium has been the coupon rate that you've got, because in the last 8 years, we've seen there was not much trading that took place in these sovereign gold bond funds. So liquidity was compromised, and for which you've got this premium.
All right. But then one thing that I want to also ask you is about buying the tranche or buying it from the secondary market. What would have been beneficial, or what would be the kind of amount you might have earned?
Yes. So, the amount of return that you would have earned if you had bought it directly in the primary market or in 2015 when the first tranche was introduced, clearly, like you mentioned, 150% of absolute return, including the interest income that came in. And if I annualize it, it comes to around a 12.5% return, plus the tax benefit that comes in, because if it's you've held it on, you've bought it from the primary market, and then the coupon interest gets added to your total income. So that gets taxed to you at the marginal tax rate. But the appreciation on the gold price is tax-free. Whereas if you would have bought it in the secondary market, now this depends on what your holding period is. So if your holding period is short-term, in that particular case, this is going to be added again to your capital gain, to your total income, and gets taxed to you at the marginal tax rate. But if this is long term for you, so if you've held it on for a 2 year kind of a tenor, then long term capital gain, and you have the option here of getting it taxed at 10% or at 20% post indexation, which means the cost would be adjusted for inflation for you. That's if you've bought it from the secondary market. So that's primarily the difference. So
What?
clearly, it would have
Sure.
been more beneficial for you if you got it in the primary market.
All right, let's also address a very important aspect, which is taxation. Now, this has been like a jackpot for you if you've invested. Shweta.
Absolutely. Like I said, if you held it on, you bought it in the primary market, then the interest income, the 2.5% is what gets added to your total income. So you've paid, the marginal tax rate, but the appreciation in the gold becomes tax free for you. So that's a bonanza, right? You've got clearly 11% post tax, or at least for that component. So the gold bond fund, clearly, if you were buying a gold fund, gold ETF, or a physical gold, compared to that, this definitely was a right option.
Because we have you, so we can also ask you this question. 8 years of gold investment in sovereign gold bond earning you so much, 128.5%, okay, with the other interest also add on to it. Now, let me compare this with a large cap fund performance in 8 years and the kind of return you might have earned.
See, a very good question, I would say, because 8 years is a long tenor, right?
Sure, it is.
And in 8 years, you get the benefit of compounding from equity. So if this was just in Nifty 50, right, just the index itself would have delivered around 13.5%. And if you get on to mutual funds, then you would have clearly got around 16.5% of returns from mutual funds. And over an 8 year period, 4% of compounding, is as good as, closer to your principal value coming back to you additionally. That's the kind of impact, almost that. So if you've invested 10 lakhs, whatever would be your corpus in the sovereign gold bond fund, if this was an equity fund, this would have yielded you easily 8.5, 9 lakhs more than that. So if I'm comparing, and if you have that kind of a holding period, then equity is where you need to be.
Exactly. So why not have a diversified portfolio where you have gold and you have equity, and looking at the trajectory going ahead with all the geopolitical tensions and also a probability of rate cuts beginning from next year onwards. At least let's hope for that. We will see. We can see a run up in gold prices as well, but then time will tell. Depends on a lot of other factors. But Shweta, from gold, let's move to equities. And for the viewers, let's talk about the AI space that's gaining traction globally, or if you talk about global markets, they're already riding on the success or the story of this AI space, okay? But we want to know what's happening in India, and if the space in India is also gaining momentum, how can you place your bet? How can you have, the brighter aspect or the brighter future of this particular space factored in your investment portfolio? Let's talk about this now. And first of all, let's understand the kind of momentum that we are witnessing in the global market of this AI space right now that's happening.
See, it's definitely the topic that's being spoken about, and globally they've been far ahead of India. So there's a lot of research investment that's already gone in, and we are seeing the output of that research globally. So it's picked up a lot of the tech companies. We've seen the tech boom that already took place in US few years back. The PE multiples, re-rating of those companies, and the effect of that on various other sectors, banking, auto, pharma, is something we've already seen globally. Coming to India, right? Just to give you certain numbers, the AI space is expected to add 450 to 500 billion to the GDP by 2025. And that's where we're seeing that momentum picking up. Of course, there's a lot of it that's going in from the government as well. We are pushing, AI for a lot of sectors. But yes, we are today seeing a lot of the sectors, today, mainly technology, of course, is developing it and using it. but sectors like pharma, agriculture, banking and financial services, education, agri, here we are seeing the usage of AI has gone up significantly over the years. So these are, I would say, the first movers, and gradually it's also getting to auto and few other sectors. Auto, retail, consumers would be the second leg of users where we are seeing the use of AI coming in.
How can one ensure that you've already priced in these factors in your portfolio and your portfolio is ready for the brighter run up of the space?
To a certain extent, yes, I would say. We've seen some of these active fund managers gradually increasing their exposure to technology. And in India, if I have to name a few companies who've been developing a lot of AI, Infosys, HCL Tech, Wipro, you'll see most fund managers have allocations there. And in the last 2 years, the allocations have gone up. Like I said, there are various other sectors also which are benefiting from it. And while we are talking about equities and personal finance, let's look at this. Banks are using it for risk management purposes, credit identification, credit risk management. Within personal finance or portfolio management, we are seeing cloud being used for data storage, data analytics, portfolio constructions, algo models being used. And there again, we are seeing allocations increasing. So I would say a lot of it, maybe if I have to just put a number, 40-50% of it is getting priced in today. Markets are very smart. They price in, the next 1 year, 1.5 year earnings already in the prices today.
Shweta, also if we talk about having this exposure in mutual funds, do you think there are specific sector funds which are dedicated to the AI space? And if we talk about other general equity funds, what are the funds which have exposure to this?
So you don't have a thematic fund, right? This would actually fall in the category of theme because AI as a theme would benefit various sectors, like I said. So today you don't have a specific AI-based theme fund, but you have a tech sector fund which is available, which could be getting a roundabout exposure to AI. So if someone wants to build that, but it may still be some bit of it already played out. Secondly, the risk of investing in any sector fund, and I've been highlighting this, is timing. It becomes very important for an investor to enter and exit at the right time. Plus, even if you're investing in the tech sector fund, you may not get the complete benefit of the AI space because it's going to have, numerous benefits across sectors who are going to actually use the AI developed by these tech companies. So I would suggest, rather than trying to run behind a sector fund or waiting out for a thematic fund to come in, you would rather get this exposure through the diversified mutual funds as well. Because what happens is any fund manager, if he's bullish on a certain theme or a sector, he'll go overweight, that sector in his diversified fund too. Plus, it's his responsibility to ensure he's booking profits and exiting at the right time and getting the entire benefit of that cycle playing out. So, my suggestion to anyone would be that even if you want to play out that AI theme, you may rather choose a diversified fund than a part sector fund that's available to you.
All right, one last question and then we'll slip into a quick break, Shweta. So AI space specific stocks or AI space focused mutual funds or maybe mutual funds that have exposure to these companies. How do you diversify within equity in this space?
So my choice again here, I would vote for AI focus, mutual funds because, like I said, you'll get the benefit of all the sectors that would benefit from AI playing out for you. The other risk is if you choose to personally invest in an AI-based stock, you need to put in that much more effort of studying the company, understanding it, and accordingly doing your own math of what projections could be of the earnings coming in because of AI developing, what or how much of that is already priced in. So there's a lot of more effort required by a investor if he's choosing a AI-based stock, which he may not have the time and the expertise to do. So going through a professional manager would be my preference.
All right, or what viewers can also do is just send us your queries and we can get them answered by experts like you.